Joining us right now is former Cleveland Fed President Loretta Mester. She's now an adjunct professor of finance at the University of Pennsylvania's Wharton School, also a CNBC contributor, and it's great to see you this morning. Before we get into it, what is your expectation, both for what we're going to be hearing on Friday when it comes to jobs and where you think the Fed is going to go with this next?
Yeah, I mean, the jobs report is going to be an important piece of the puzzle in determining what the Fed's going to do at the September meeting. I don't think there's any question that the Fed's ready to start the easing cycle. I think they will have a discussion about whether they want to start with a 25 basis point move or a 50 basis point move. But more important even than the first cut is sort of the path of rate cuts coming after that. And we're going to get information from the Fed on that, because we're going to have new summary of economic projections. So I think that's going to be really one of the key pieces of information coming out of the meeting. I mean, the jobs report, we know the job market has been moderating. And I use that word moderation as opposed to weakening, because remember, the job market has been quite tight. So we've seen this loosening in conditions. The chair coming out of Jackson Hole said he wanted to not go much weaker than where they are now in terms of the job market. And I think that's why there's been this real focus on that upcoming report. But remember, the Fed looks at all the data coming out, not just one report.
Well, but let's just talk about this Friday, because there is this sense that, is good news going to be good news? If the news is too good, is that actually bad news? Because then the Fed maybe won't cut as much as people had anticipated. Put us inside the room.
Yeah, look, the Fed wants to have strong labor markets. So, and from the point of view of the FOMC and their focus on maximum employment and price stability, having a good, solid jobs report is a good thing for the committee. I don't think there's any question about that. But they also recognize that, inflation has been coming down, and it's time to start moving the interest rate, the nominal Fed funds rate, their policy rate down as inflation and short-term inflation expectations have moved down. Otherwise, you're actually inadvertently tightening policy, and that's not what the economy is calling for now. So I think they're going to want to see that labor markets remain healthy as one of the pieces of, okay, we can now start this tightening cycle, and we will be able to kind of move the rate down with the economy telling us how quickly we need to move it down in order to maintain those healthy labor markets. So from the FOMC's point of view, and I would say for the economy's point of view, you want to see a good labor market report coming out this Friday. That's not going to change people's minds on, whether to start cutting.
Right.
The chair was very clear, extremely clear in Jackson Hole that the committee's ready to do that. I think the question in the room will be, do you start out with a 50 or a 25? And I think they won't really determine that going in until it gets closer to the time.
Loretta, what do you make of I know you're not an equities person, but of the move in the equity market? The Wall Street Journal has a piece out this morning just talking about all the sort of new 401k millionaires and folks who have made a lot of money during this period, and how much that, in terms of the wealth effect and other things, that impacts the way the Fed thinks.
Well, no, the Fed does look at financial conditions, and one part of that condition is what's going on in the equity markets, because we do see a wealth effect in the economy. But again, it's one of the pieces of financial conditions that it looks at. It doesn't sort of focus only on what's going on with stock markets. It looks broadly defined, and financial conditions have been, tight over this whole cycle as the Fed has raised its policy rate at different times, up and down. Some of the indices are saying that, things are back to neutral in terms of those financial condition indices now. So that's one piece of the information the Fed looks at, certainly, but it's not a focus on sort of targeting the financial markets. It looks at it in terms of, are financial conditions too tight to support healthy labor markets and a return fully to 2% inflation?
If, in fact, the Fed does lower rates, and I think, whether it's 25 basis points or 50 basis points, I imagine there's going to be finger pointing in the political world about what the Fed is doing, the independence of the Fed, if they're trying to encourage one candidate to win over the other. In this case, I could see someone like former President Trump suggesting that this is an effort to make to make the vice president the president. I know the Fed likes to say that doesn't weigh on anything, but do you think it even weighs the distinction between a 25 basis point cut and a 50 basis point cut?
Yeah, honestly, I really don't think it does. I think they have to do what they always do, which is look at the economy, look at where it's going, look at its policy rate to see that it's, aligned with where the economy is going and the achievement of its dual mandate goals. Politics doesn't enter the room. They're going to look at this from the point of view of the economy. What is the economy telling us that the Fed needs to do with policy to get it aligned so that it can fully reach 2% inflation at the same time maintaining healthy labor markets? And there's going to be criticism on whatever they do. And they take that in stride and know that's going to be, what it is, but that's part of the environment. And they have to focus on, stick to the knitting. They have to focus on doing what they can do with their policy tools to achieve the dual mandate that Congress gave it. And that's what they're going to be focused on in that room.